Hi everyone. We're working through budgeting today. Quite a helpful, practical task. Not sure how long it would take us. I trust only perhaps 30 minutes. Let's see what we can do. Let's launch in and see what we can pick up today. I have to give a shout out to Greg Dean, a fellow teacher who developed a lot of these slides today, and they're very interactive and helpful. So many thanks to him for his work in getting these together. So today, looking at this master budget, we just build, you'll see today how one budget feeds into the next. There's many slides, we'll just track into each other. So we'll build a budget from scratch. We'll also talk about the human aspects of budgeting, and possibly really what we want to do is we have a whole lot of managers in our production facilities or service centres that are responsible for that particular division, and they've got a budget, and their aim is to, as best they can, achieve the goals set out in that budget. So a whole lot of communication happening in the budgeting process, and you can imagine if you've got a multinational company, you've got to deal with the complexities of exchange rates fluctuating and different economies, and so you've really, the best way to produce a budget is to have people who are there on the ground, who have been working locally. Very difficult for us here in Australia to try and produce a budget for some division over in San Francisco, say. But let's move on. Let's see what we can do. What is it? A budget's a quantitative, meaning, you know, how much, quantities, how much, expression or a plan, if you like. It can include financial and non-financial data, so dollars and some non-dollar stuff. For example, your labour hours, component parts, numbers of parts. There's no dollars there. It's just where we're working out. They're included. So hours and parts, yeah. So, and if you aim at nothing, you'll probably hit it, catch phrase for budgeting. So this particular company has had a 20% revenue increase compared with a 10% increase the year before. And you might at first glance think, wow, what a great performance. But what if the rest of the industry had a 40% increase? Not so good. So it's always good before you celebrate too hard or beat yourself up too much. Look at what's going on in the big picture and the rest of the economy. So this season with COVID, a lot of budgets just thrown out the window. Everything's got to be adjusted and changed, and it's just totally understood that we just won't be able to, in many industries, meet the goals that we'd set. In some, possibly in some of those retail areas, be exceeding the budget. So there'll be some folks, online sales and whatever, that are exceeding their expectations. All levels of management should be involved in the budgeting process, and that makes sense. And these are the people that know what's going on, first-hand experience with what's happening. So it's estimated that managers are spending around about 10 to 50% of their time on the budgeting process, forecasting into the future. The budget is not the end in itself. It's not like a law that you have to lay down and no, if it's not in the budget, we don't do it. We do need to be flexible, and there are times when we want it would be in the firm's advantage to move away from the budget, cut back or expand as circumstances change throughout the period. So we will be all the time, part of our planning, directing, controlling will be just looking for feedback, comparing actual results with the budgets, working out what's working well, why aren't we achieving our goals perhaps, do we need to adjust them? So all those sorts of things to take into account. And again, this slide is just letting us know that really we want everybody involved. We want people to own the budget. So rather than feel that it's being passed down from top management, it's nice if all the data can be fed and summarised, and you've had some input into the setting the goals and the budgets for the period. So what are some of the human behaviours that we would see in the budgeting process? There would be some that would be tempted to try and look good, perhaps, and set goals that are just, too unrealistic. Just can't make it. But perhaps they're just optimistic sort of people, and they think, we can do it, we can do it. And then other people who are a little bit more timid, maybe, or a little bit apprehensive, or set very achievable goals, so it makes, perhaps they feel that will make them look good when they easily achieve their targets. And then we also have some conflicting budget goals. You've got one goal to increase your market share, but at the same time you want to maintain these or increase selling prices. Well, if you've studied economics, you know that when you increase prices, the product becomes a little less attractive, demand drops. So how can you increase market share and at the same time increase selling prices? So there'll be some conflicting goals there from time to time. And also the particular individual's goals may differ from the business objectives. So the salesperson who earns a commission on sales, he'll be tempted to keep selling prices as competitive as possible, and would want to, really go hard with his advertising expenditure to make his job easier, get his product launched and out there, and make it easier to generate sales. So these are all the things, the advantages that we get out of budgeting. Certainly we're planning for the future. It helps us communicate, coordinate activities, possibly work out any potential issues. Helps us allocate resources. Can we achieve? And one of the things that we might do is set what is our maximum capacity. What is with our current plant facilities? If we went hard with no breakdowns, no strikes, no errors, what is the most that we could possibly achieve? And that's helpful to just know what the upper limit is, what the ceiling is, just in case there happened to be a rush on demand. And that would have happened through this COVID period with demand for, say, personal protective equipment, masks, etc. There would have been some firms that would have been really swamped with sales and been trying to do everything they can to meet the demand. So we would have these detailed budgets feeding into our master budget. So sales, we'll start with sales, then move to production and materials. We'll see that happen in the next few slides. The static budget is where we have just a set volume, and here we are, we're doing exceeding the budget perhaps. Flexible budget, we might have a few what-if scenarios. Let's set the budget at different levels of activity and compare how do we go against those. A rolling budget's a good idea. We're just going to make it breaks down a big task into, we always want to have 12 months in advance. So one of the things we can do then is just be preparing 1 month's worth of budget for the following. As we complete February this year, it drops off and next February is added. So we've always got 12 months worth of budget rolling around from month to month. So we might start off with a single level of volume, single product, and see where we go from there. Let's have a look. Sales budget feeding into the production budget, direct materials purchase budget, direct labour budget, manufacturing overheads, putting it all together, cash budget, and finally getting through to our budgeted financial statements. So let's have a go. We'll start with the sales budget. It essentially, if you think about what you've been doing when you've been doing your revenue accounts, you say opening stock, add, purchases or units produced minus closing stock equals your sales. So this is just the reverse of that equation, saying, look, what are my expected sales units? What would I plus? What would my desired units of ending stock in finished goods? What would I like that to be? Minus estimated finished goods stock at the beginning must give me the value, the units that I need to produce, and that will transfer into the production budget. From there, we can break the production budget down into materials and the same sort of thing. Materials needed for production plus any stock required for closing inventory, just in case we have some excess demand, minus estimated beginning inventory will get us, well, that's what we need to buy in. We also then will do our labour budget and our factory overhead budget, and that will feed into our cost of goods sold. So let's have a look at a budget example. We'll throw some data at it. We've got this, we've estimated these potential units of sales over the next 5 months, and we've got a selling price down here. So away we go. Set out our budget. Excel spreadsheet really lends itself well to the budgeting process. So first thing to slot into our budget is the estimated sales we're hoping for. And we've got the quarter, 3 months, quarter ended, added those together. Put in the selling price, and we've got estimated sales in dollar values. So we've completed our sales budget. We're ready to transfer that data into the production budget. We would like our ending inventory to be 20% of the following month's budgeted sales. And we had started with 4,000 units on hand. So let's have a go at our production budget. So again, these are units just brought forward from the sales budget, starting with the sales. Then we're adding the required budget, 20% of the next month's sales, 20% of 50,000. So I'd like ending inventory to be that. 20,000 and 10,000 adds to 30,000, minus beginning stock given in the question will give me my required production for April. And we just continue that trend. Note that the ending inventory for April will become beginning inventory for May. So we'll see that transferred down. And same sort of deal here, keep looking at the next month's sales, find 20% and plug that data in. 50 plus 6 gives me my 56, minus the opening stock brought forward from the previous month gives me my required production for May. We continue that process through for June, carry the stock down, and just be aware that for our quarter, of course, the end of June is the end of the quarter, so we can just carry forward the closing stock at the end of the quarter, 5,000. The beginning stock for the quarter is the stock at the beginning, the end of March or the beginning of April. So we carry that forward down, and therefore that figure there, total required production, will now balance with these 3 months worth of production figures. So we've completed the production budget, ready to move into the direct materials purchase budget. And so we just look at, well, what do we need for every completed finished good? We need 5 kilos of raw material or component part. And we want our materials to be 10% of the following month's production. So we follow a very, very similar trend for our materials budget. Bring forward the figures from the production budget, work out what raw materials are required, and so that multiplied by the 5 materials per unit will give me my production needs. So that's what production needs in terms of raw materials. Then let's increase that by the desired ending inventory, which is 10% of the following month's production. So we've 10% of that, we've brought that down. Less the beginning stock in raw materials or direct materials, and that's the materials required to be purchased for us to be able to maintain our production. levels. We just do the same sort of thing, keep repeating the process, bringing forward the desired inventory, similar to what you saw us do in sales. Bring forward the ending inventory for April is opening inventory for May. Bring that down and continue the trend. And finally, the desired ending inventory for June is the desired ending inventory for the quarter, and opening stock for April is the opening stock for the quarter, and this should add across to this. We then could put some dollar values on. So this is exactly the same budget as you saw. Let's put some dollar values on at 40 cents, and we've now got the cost per kilo, or our purchases budget, if you like, direct materials purchases in dollars. There are quite a few YouTube clips if you wanted more help on any of these. They walk through, I think they're about 10 to 15 minutes each if you wanted to look at some more exercises. We'll have a look at a couple of divisions here. Excuse me. We've got a couple of different products, it seems, wallets and handbags, and different selling prices. So it's just more of the same, but with just more data, more detail added to our budget. Complete the sales budget, same sort of deal. Transfer it through to our production budget. And we've got our, and transfer the sales through, do the whole stock calculation again, and we'll know what we need to produce to be able to generate those sorts of sales. So we've completed the production budget, go ahead and do the materials budget, and each product is going to require different amounts of leather. So cost that out, or at least cost it out in terms of leather requirements. Very similar, just gather the data. We keep repeating the process. We'll do some questions in class. Finally, put a dollar value on it per metre. Once we know the total metres we need to be able to meet our production requirements, multiply by the unit price, and we've got our direct material purchases budget for our different, direct materials. Done the direct materials purchase. Now let's do the direct labour budget. Similar sort of thing. Look at your different products, work out how much labour is required in the different departments, cost that out. 520,000 units at 10 cents per hour per unit, 52,000 hours. Do the same with your other products. Work out what how long on average they take. Work out the total hours requirement. And once we've got the total number of hours, multiply by our hourly rate. Sewing department are paid on average a little higher than the cutting department. Cost it all out, and we've got our direct labour cost budget. Once we've done that, we're ready to move on to our factory overhead budgets. We look closely at all of our indirect costs, supervisor salaries, factory power and light, indirect materials, maintenance, add it all up, and we've got our total factory overhead costs, budgeted costs. We've done that. We're ready now to transfer this into the cost of goods sold. This is going to look very similar to what we completed in about week 1 or 2. I think it was week 2, where we're pulling forward data from previous our previous work in the budgets. And so we've got what are the 3 component parts, and the only difference is they've got finished goods stock right at the top here. We didn't do that. We started with work in process at the beginning of the period, and then we added direct materials, which was, opening stock, add purchases minus closing stock, gives you the cost of direct materials that must have been transferred to production. Then we add labour. Then from the labour costing sheet and a budget sheet and the factory overheads, add the 3 main component parts: materials, labour, overheads. Add them together. Total manufacturing cost is that, plus our opening stock of work in process, less whatever work in process is on hand at the end must be the value of completed production transferred out to the finished goods warehouse. Opening stock of finished goods plus cost of goods manufactured minus closing stock of finished goods will give us the cost of goods sold. So we've got right down to the cost of goods sold budget. We're very close to the end. Done the cost of goods sold budget. We're ready. I think this might be the last slide. Ready to put the rest, look at our operating expenses over in the admin area of our business. Look at all of those costs, put them together, and we've got our operating expenses. And we're ready then. Pretty much the last thing that's left is potentially we put it together into our revenue statement, and we're ready to do our budgeted balance sheet from there. So there it is. So very similar to what you saw us reporting on in week 2, our revenue statement. Revenue, bringing forward sales from the sales budget, less cost of goods sold, bringing forward from that previous slide, gets us down to our gross profit, less all of our other selling expenses gives me our net profit, add any other revenues, income, less tax, and bang, net profit after tax. All right, well, look, that'll do us for the moment. We'll do some, it should be fairly straightforward. We'll do, we're just working with the data we've got. So we'll use Excel to solve some problems when we get together in class. So look forward to seeing you then.